Welcome to the Deep Dive, the show that takes the complex and turns it into compelling knowledge.
Glad to be here.
Today, we're tackling a concept that often gets a bit of a bad rap: accounting.
The dusty textbook stereotype.
Exactly. But forget all that. We're going to uncover how internal business data, what we call management accounting, is transformed from, a chore into a real proprietary competitive weapon.
It's an absolutely essential distinction to make. I mean, when you look at the greatest, most consistently profitable companies out there, they aren't successful just because their product is marginally better. They're successful because their internal intelligence system gives them insight. Their competitors just, well, they don't have.
We're moving far beyond just public scorekeeping here.
Far beyond.
And we really need to establish that core difference right up front because it defines this entire deep dive. So think of it this way. Financial accounting is all about external communication.
Right. It's the public scoreboard.
The public scoreboard, governed by these strict uniform rules so that investors, anywhere in the world can compare Apple to Microsoft. It's focused on the past.
But management accounting, that's a whole different beast. That is your internal, custom-designed, private playbook.
I love that phrase, a private playbook.
It is. It's the unique blueprint for your operation. And it doesn't follow standardized rules because, well, if your competitor could read your playbook, you'd lose your edge completely.
So it's about shaping the future.
Precise.
And that is our mission today. We are dissecting the what, the why, and maybe most importantly, the how of using this internal data to achieve, well, strategic dominance. We'll be pulling insights from historical titans like DuPont all the way to savvy modern businesses. Okay, so let's kick things off with the what. When we say management accounting or MA, our sources frame it not as a necessary evil, but as a genuine intellectual asset.
It is entirely an intellectual asset. You can have the best product, the most talented people, the most efficient machinery. Those are all your tangible assets.
Right.
But MA is the intellectual architecture that optimizes the use of all those other assets. It's the internal intelligence for making superior decisions, designed purely to maximize performance for your company and your company alone.
I think the most important takeaway from our sources on this is that focus on uniqueness and usefulness.
Yes.
While financial accounting is, obsessed with uniformity and neutrality, making everything look the same across the board, MA demands customizability.
It has to be customized. If the system you build is useful to your strategic team, that's literally all that matters.
And this strategic nature, it's been there from the very beginning. It wasn't born out of some external regulation or a government mandate saying, you must track these numbers.
Not at all. The sources highlight the origin story at DuPont in the early 1900s. As the company grew into this sprawling, incredibly complex multinational, the leadership realized they couldn't run the business effectively just by, looking at annual balance sheets.
So they didn't have a reliable way to compare, say, their explosives division with their paint division.
Exactly. They were flying blind. They desperately needed to know where they should commit their limited capital to get the absolute best return.
That internal need, that desire to simply run the business better than anyone else, that's what led to the innovation.
That's right. And it led to core management principles we now take for granted, like calculating return on investment or ROI. It was a self-motivated innovation developed purely for a competitive edge.
DuPont wasn't filing their ROI calculations with the SEC.
Of course not. They were using it internally to crush their smaller, less informed rivals.
And that history really drives home the why of all this, why it's so critical for any leader. If you just view accounting as this backward-looking chore,
You're flying blind.
you're flying blind, and you are guaranteed to suffer from 3 major risks that MA is specifically designed to eliminate.
And the first one is the most devastating: inefficient resource allocation. If you don't have accurate internal intelligence on your true costs and your true returns, you end up investing heavily in areas that, they look successful on a public ledger, but they're secretly yielding very low returns.
So you put capital where it's comfortable, not actually where it's most profitable.
And your competitor, who does have that granular data, is pouring money into the high-margin, high-growth areas you just completely overlooked.
Okay, what's the second risk?
The second is equally damaging: blunt, ineffective marketing. If you only track overall sales, you just end up wasting promotional dollars.
You send generic coupons to everyone.
Right, including your most loyal, highly profitable customers who are going to buy the product anyway. You're basically just throwing away margin on a customer you already had.
And the third risk, which I feel like we see everywhere, is poor pricing and costing.
Oh, constantly.
Mm.
This happens when you rely on, say, industry averages or these simple markup formulas. You either bid too high and you lose profitable business,
Or, even worse, you bid too low, you win the contract.
and then you spend the next year fulfilling a job that costs you more money than it brings in. That is a catastrophic failure of management accounting.
So understanding this difference is the fundamental shift. It transforms accounting from a mandatory cost center, the team that just reports what happened.
Into a forward-looking strategic partner that actively defines your market position and your competitive approach.
Okay, so let's unpack that transformation. If MA is the internal playbook, how does that proprietary intelligence actually translate into the kind of dominance that, crushes the competition? Our sources lay out this competitive edge loop.
It's a virtuous cycle. Better data leads to better insight, which leads to better decisions, which creates more effective operations.
And that ultimately drives higher economic profits and sustains that competitive advantage.
It is a loop of constant improvement and learning.
So to make this really concrete, let's
Yeah.
use the classic case study from the sources, the restaurant face-off. We're contrasting two identical businesses, same food, same neighborhood.
Okay, so restaurant number one is the traditionalist. Their accounting is administrative, it's purely reactive. They track sales, they pay their bills, they handle payroll.
Compliance, compliance, compliance.
Exactly. Their mindset is simple. We sell good food, and if we serve enough customers, we'll make a profit. They're looking in the rearview mirror.
And then you have restaurant number two, the strategist. Their management accounting function operates as a dedicated intelligence engine.
Their mindset is totally different. It's we manage a profit system. Their goal is to identify and influence the economic drivers, the customer behavior, the operational efficiencies that maximize every single dollar spent.
And this is where the strategist just pulls away, right? In the granularity of the data.
Absolutely.
Mm.
The traditionalist knows they sold 100 steaks this month. The strategist knows that the sirloin steak is a high-volume, low-margin item, but the ribeye, which takes the same labor and kitchen time, has a 65% contribution margin.
That's precision profitability analysis.
That's what it is. So they can eliminate the hidden money losers and strategically push the high-margin items through specials and menu placement.
That level of detail, it seems almost overwhelming. Couldn't they get bogged down in too much data? Isn't there a risk of, analysis paralysis?
That's a fair question, but the goal isn't more data, it's smarter data. The strategist doesn't track every grain of salt, they track profit drivers. And critically, they focus on something called operational leverage.
A concept the traditionalist completely misses.
Entirely.
Can you elaborate on operational leverage? That's a term that sometimes gets lost in the financial jargon.
For sure. Operational leverage is essentially how efficiently a business uses its fixed costs to generate profit. Think about rent.
Okay, a fixed cost.
Right. Rent for a restaurant is fixed. You pay the same amount whether you serve 10 customers or 1,000. The strategist knows that once they cover their fixed costs for the month, every subsequent dollar of sales drops much more effectively to the bottom line.
So their accounting system is designed to pinpoint how to maximize sales during those high leverage periods.
Yes, and specifically, how to drive traffic on a Tuesday night, their lowest point, to maximize the use of that capacity they've already paid for.
So data allows them to squeeze more profit out of the existing structure, while the traditionalist is just sort of hoping the fixed costs get covered.
Exactly. And the data extends beyond just operations. It leads to superior customer intelligence and targeted action.
The traditionalist sends out flyers on busy weekends.
While the strategist tracks buying patterns and demographics, and they know when a profitable regular who used to spend $150 a month has suddenly stopped visiting.
So instead of a generic coupon, the strategist can send a personalized offer to that specific loyal customer. Something like, we notice you haven't been in for a few weeks. Enjoy a complimentary appetizer on us.
That's the power of MA. It turns marketing into an investment with a measurable ROI, not a scattershot expense. They can even use their pricing strategy with surgical precision.
Like using strategic loss leaders.
Right. They can confidently run a popular dish at a slight loss because the data proves it drives traffic for the much higher margin wine or desserts. The traditionalist just sees a loss and raises the price, driving customers away.
So the ultimate divergence here is crystal clear. Restaurant number one understands accounting debits and credits, the mechanical rules.
But restaurant number two, they understand economics. They understand profit drivers, customer behavior, operational leverage, and how to mold the future, not just record the past.
And that superior economic understanding is why management accounting can never be a static thing.
It can't be. The competitive advantage you gain this year, say, through a new costing method, will be the baseline expectation for the entire industry 5 years from now.
It's a continuous arms race. The sources really emphasize that MA is a dynamic experimental process. It involves constant innovation, experimentation, and diversity.
What worked for DuPont 50 years ago is just table stakes today. You have to constantly tinker and re-examine your internal information system.
And this necessity for constant proprietary tinkering is what creates this fascinating paradox we see in global business today.
The debate over establishing international management accounting standards.
Okay, this is where it gets really interesting. I mean, on one hand, you have this massive global economy. Surely wouldn't some standardization be helpful?
It seems logical.
Right. If a giant multinational like Siemens or Toyota has divisions in 40 different countries, wouldn't having a common definition for contribution margin or ROI just streamline internal reporting and improve efficiency?
And that's the entire case for standards, and it's a powerful one. Consistency would, without a doubt, streamline joint ventures, internal transfers, all of that. If you acquire a subsidiary in Brazil, you want to know their cost calculations use the same framework as your plant in Germany.
But, and here's the core argument against it, standardization risks destroying MA's proprietary value entirely.
It risks gutting the whole thing. If we agree on a standard way to measure profitability, we're effectively giving away the custom playbook.
You're eliminating the competitive edge.
Exactly. The source material views MA as a proprietary technology. You wouldn't force Apple to use the same internal design specs as Samsung, forcing all firms to use the same internal reporting metrics. Well, it eliminates the unique insight that lets the strategist restaurant beat the traditionalist.
And this resistance to uniformity, it's not just strategic, it's deeply cultural, which I found really compelling.
Oh, absolutely. Research shows that management accounting systems that work perfectly in one country might actually harm performance in another, all based on national psychological factors.
Like uncertainty avoidance.
Right, the extent to which a culture feels threatened by ambiguity. Take Korean firms. They typically score very high on uncertainty avoidance.
Okay.
So they gravitate toward using many, often dozens, of performance measures and metrics. It's about reducing ambiguity and maintaining tight, explicit control. For them, multiple indicators validate the data and make decisions feel more secure.
A standardized system with fewer metrics would feel incomplete.
It would feel incomplete and probably lead to hesitation. Now, conversely, look at Australian firms, which score much lower on uncertainty avoidance.
So they're more comfortable with ambiguity.
Much more. They generally prefer more flexible, simpler systems. For them, all those extra metrics that the Korean firm loves are just seen as unnecessary red tape that hinders innovation and slows down decision-making.
So if you try to impose the complex multi-metric Korean system onto an Australian division, you don't gain efficiency.
You generate cultural resistance, and you actively reduce the local team's ability to compete effectively. A one-size-fits-all approach is just a prescription for mediocrity in a global business.
So this all boils down to a fundamental divergence in purpose. Financial accounting's path is clearly convergence.
Marching toward global unification to serve external capital markets.
But management accounting's path must be divergence and adaptation. It has to constantly evolve and bend to serve the unique strategic needs of the firm, its economics, and its specific culture.
Its power is in helping a company be uniquely and strategically itself.
So when we pull this all together, what does this all mean for you, the well-informed leader?
We've really covered 3 critical layers of understanding MA.
We have.
Functionally, it plans and controls operations. Strategically, it provides the superior economic insight you need to crush the competition.
And philosophically, it is a proprietary, constantly evolving innovation engine.
The conclusion seems to be that competitive success is no longer about just gut feeling or, selling the best product.
It really isn't. It's secured through the disciplined practice of turning raw internal data into an actionable economic playbook that no competitor can copy. The savvy business doesn't just transact, it manages a profit system based on operational leverage and deep customer intelligence. That is the recipe for sustainable dominance.
And as organizations continue to globalize and manage divisions across these incredibly diverse cultures, that challenge only intensifies. Absolutely. And that leaves us with a final thought. Think about this. If the best practice is not to impose a single, rigid management accounting system worldwide because it clashes with local competitive needs and culture.
Right.
How do you manage that tension? How do global companies balance giving local units the cultural flexibility they need to innovate and compete locally while still maintaining enough data consistency and reliability for headquarters to evaluate and compare overall global performance?
That's the strategic tightrope.
That is the strategic challenge of the well-informed leader.